Most traders treat their prop firm account like a lottery ticket. They buy one, gamble hard, and hope it hits. If it does, they post it online. If it fails, they blame the rules, the spreads, or the market. But hedge funds don't gamble. They manage. They protect their capital first and grow second. That's why they last decades, while most retail traders don't last 6 months. Today, I'll show you how to trade your prop firm accounts like a hedge fund. Because once you start thinking like a fund manager, not a gambler, your entire trading career changes. Let's start with the simple truth. Most traders think passing a challenge is the goal. But that's just the start. The real challenge begins after you pass. Because that's where most traders lose everything they worked for. They get a funded account, make 1 or 2 good trades, then give it all back. Why? Because they never learned how to protect what they earned. And protection is the first rule in the hedge fund world. Think it like this. If you manage a $100,000 account, that's not your money. That's someone else's capital. Your only job is to grow it safely. If you blow it, you're out. There are no second chances. That's the same mindset you need in prop trading. The prop firm is your investor. Your account is your fund. Your payout is your performance fee. If you treat it that way, you'll start trading differently. Here's what hedge funds do right that retail traders ignore. They diversify. They spread their risk across assets, strategies, or portfolios. In prop trading, you can do the same by splitting your capital across multiple accounts instead of going all in on one. Let's make it simple. Imagine you have one 150K account. It has a 10% drawdown limit. That means you can lose $15,000 before you're done. Now, imagine instead of one 150K account, you have 3 50K accounts. Each one has a 10% drawdown. That's $5,000 per account. In total, that's still $15,000 in total drawdown. But now you have 3 different chances to make money. If you lose on one, you can still recover on the others. That's what hedge funds do. They spread risk to protect capital. Here's where things get even more interesting. A smart trader doesn't just spread risk. He rotates his accounts. And this is one of the most powerful tricks you'll ever learn. Let's say you've got 3 accounts. You take a trade and make 2% on all 3. Now most traders would keep trading those accounts. They'd think, I'm on fire right now. But that's how they lose. Because the more you trade, the higher your chance of giving back those profits. A hedge fund manager would never risk realized profits once they're secured. He would lock them in. So what do you do instead? You stop trading those 3 accounts. Wait for the payout date. Collect your payouts. And while those payouts are processing, you rotate to a new account. Now, if your next trade loses, it doesn't touch your payouts. You lost on a clean slate, not on your profit. That's how you build month after month without destroying your old wins. That's what trading like a hedge fund looks like. Let's make it even clearer with a quick example. You have 3 accounts of 100K each. You make 2% on all 3. That's 6K total in profit. Now you pause those 3 and start trading 3 fresh ones. If you lose 2% on the new set, your total result is still plus 4K. But if you traded the same old accounts, that 2% loss would have erased 1/3 of your previous profits. This small habit is what keeps you consistent while others keep restarting from zero. That's what real capital management looks like. It's boring, slow, and disciplined. But it's what keeps professionals in the game year after year. Because in trading, your main job is not to make money fast. It's to stay alive long enough to make money consistently. And by the way, if you want to see the prop firms that I personally recommend for this style of trading, check the link in the pinned comment. You'll find the best prop firm options and promo codes there. It also helps support this channel, so I appreciate it if you check it out. Now back to it. Let's talk psychology for a second. Every trader says they have discipline until they start losing. When you trade one account, every loss hurts double. You start revenge trading, doubling risk, trying to win it all back. That's how hedge funds die. That's how traders blow accounts. But when you trade like a portfolio manager, your emotions stay calm. You know, a loss on one account is just a scratch, not a wound. You simply rotate. You move to another account and trade the next setup clean without emotion. That's what big money does. They never trade from anger. They never trade from drawdown. They trade from structure. You see, hedge funds don't bet their future on one good day. They know one week means nothing. They measure performance over quarters and years. You should do the same. If you can make 2% per month consistently, that's 24% a year. That's elite level performance. Most hedge funds in the world would kill for that return. So if you're trying to make 20% a week, you're not trading. You're gambling. The key is to think bigger picture. Stop trying to make one giant payout. Start trying to build a structure that gives you small payouts every month. Because once you can do that, you can scale up safely. Hedge funds don't scale with emotion. They scale with data. And so should you. Now let's break down how to actually run your prop firm accounts like a hedge fund step by step. Step 1, split your capital. Don't put everything into one big account. Start with several smaller ones. This gives you multiple lifelines. Step 2, set your target per account. You don't need to make 10%. Even 2 to 3% is enough when you have multiple accounts. That's consistent, safe growth. Step 3, rotate after profits. Once an account hits your monthly goal, stop trading it. Move to a fresh account. That way you protect your payout and start each new phase with a clean slate. Step 4, track your performance as a portfolio. Stop thinking about one account at a time. Add up the performance of all your accounts. If account A made 2%, account B lost 1%, and account C made 3%, your total gain is still positive. That's portfolio management. That's what funds do. In step 5, focus on survival over perfection. A good hedge fund doesn't win every month. They just make sure the bad months are small. That's exactly what your trading should look like. Let's simplify this with an example. Imagine you run 5 accounts of 50K each. Each one has a 10% drawdown limit. That's a total of 25K in total drawdown across all 5. You risk 1% per trade per account. That's 500 per position. If you win 2% on average per month, that's 1K per account or 5K total. Now multiply that across 12 months. That's 60K per year with very low risk. That's how real capital grows. Slow, steady, and scalable. That's how hedge funds do it. And that's how you should do it too. Another big part of trading like a hedge fund is avoiding ego. Ego destroys more accounts than bad entries ever will. Retail traders try to prove they're right. Funds try to survive to trade another day. If your setup fails, you close it and move on. You don't fight the market. You don't add to losers. You don't try to win back revenge trades. You follow the plan. Because a trader with a plan will always outlast a trader with emotions. Here's something most traders never think about. Hedge funds get paid on performance fees, usually around 20% of profits. That's exactly what prop firm payouts are, your performance fee. So if you think like a fund manager, your job is to deliver steady returns to your investor, which in this case is the prop firm. You're not paid to gamble. You're paid to perform. And consistency is what keeps your payout stream alive. That's how you make this business long-term. I know this may sound less exciting than flipping an account or passing a challenge in 2 days, but that's what separates amateurs from professionals. Most people want to look rich. Hedge fund style traders want to stay rich. And that's the only difference that matters. If you made it this far, you already think differently from 90% of traders. You're focused on the system, not the hype. And if you want to keep improving, check the link in the pinned comment for the best prop firms and promo codes. It's the same link I use to support this channel, and it helps me make more videos like this for you. Also, don't forget to like this video and subscribe so you never miss a new upload. Let's wrap this up with the mindset of a real professional. A gambler thinks, how much can I make? A hedge fund manager thinks, how much can I lose and still survive? A gambler needs to be right once. A hedge fund manager needs to be disciplined always. Your job as a prop trader is not to predict the market. Your job is to manage risk, protect payouts, and play the long game. Because in the end, trading isn't about how much you can win today. It's about how long you can stay consistent. And if you can do that, you'll separate yourself from almost everyone else in this industry. So start thinking like a fund manager. Split your risk, rotate your accounts, and treat every payout like your investors' trust. That's how you build long-term income from prop trading. And that's how you stop being a trader and start being a manager of capital. Thanks for watching. Check the pinned comment for the prop firm link and promo codes. Like the video, subscribe, and I'll see you in the next one.